This LOS is defined forward contracts, future contracts, options, calls and puts, swaps, and credit derivatives, and compare their basic characteristics. Derivatives, definitions, and uses. There are three types of forward commitments: forward contracts, futures contracts, and swap contracts. These contracts can refer to more simply as forwards, futures, and swaps. A forward contract is an over-the-counter derivative contract in which two parties agree that one party, the buyer, will purchase an underlying asset from the other party, the seller, at a later date at a fixed price they agree upon when the contract is signed. A futures contract is a standardized derivative contract created and traded on a futures exchange, in which two parties agree that one party, the buyer, will purchase an underlying asset from the other party, the seller, at a later date at a price agreed upon by the two parties when the contract is initiated, in which there is a daily settling of gains and losses and a credit guarantee by the futures exchange through its clearinghouse. Finally, a swap contract is an over-the-counter derivative contract in which two parties agree to exchange a series of cash flows whereby one party pays a variable series that will be determined by an underlying asset or rate, and the other party pays either one, a variable series determined by a different underlying asset or rate, or two, a fixed series. Forward commitments. Forward commitments are contracts entered into at one point in time that require both parties to engage in a transaction at a later point in time, the expiration, on terms agreed upon at the start. The parties establish the identity and quantity of the underlying, the manner in which the contract will be executed or settled when it expires, and the fixed price at which the underlying will be exchanged. This fixed price is called the forward price. With regards to forward commitments, 1, they're customized, no active secondary market. 2, the long is obligated to buy, the short is obligated to sell. 3, there's a specific asset, currency, stock, index, or bond. 4, specified date in the future. 5, the long gains if the asset price is above the forward price. The short gains if the asset price is below the forward price. They're either deliverable or cash settled. And finally, the transaction is essentially unregulated. Forward contracts. A forward contract is an over-the-counter derivative contract in which two parties agree that one party, the buyer, will purchase an underlying asset from the other party, the seller, at a later date at a fixed price they agree on when the contract is signed. So some characteristics of forward contracts. 1, a forward contract is a commitment. Each party agrees that it will fulfill its responsibility at the designated future date. 3, failure to do so constitutes a default, and the non-defaulting party can institute legal proceedings to enforce performance. 4, an important element of forward contracts is that no money changes hand between parties when the contract is initiated. Maybe I should have put that in bold. That's a key point with regards to forward contracts. An important element of forward contracts: no money changes hands between parties when the contract is initiated. 5, forward contracts need not specifically settle by delivery of the underlying asset. They can settle by an exchange of cash. These contracts, called non-deliverable forwards, NDFs, cash-settled forwards, or contracts for differences. So continuing with forward contracts, we're just going to look at an example here. Suppose two parties agree to a forward contract to deliver a zero-coupon bond at a price of 98 per 100 par. At the contract's expiration, suppose the underlying coupon bond is selling at a price of 98.25. The long is due to receive from the short an asset worth 98.25, for which a payment to the short of 98 is required. In a cash-settled forward contract, the short simply pays the long 25 cents. If the zero-coupon bond were selling for 97.50, the long would pay the short 50 cents. Delivery of a zero-coupon bond is not a difficult thing to do. However, and cash-settled contracts are more commonly used in situations where delivery is impractical. For example, if the underlying Russell 3000 index the short would have to deliver the long a portfolio containing each of the Russell 3000 stocks proportionate to its weighting in the index. Consequently, cash settlement is much more practical. Now we're moving on to futures. Futures contracts are specialized versions of forward contracts that have been standardized and that trade on a futures exchange. By standardizing these contracts and creating an organized market with rules, regulations, and a central clearing facility, the futures market offer an element of liquidity and protection against loss by default. Formally, a futures contract is defined as follows. A futures contract is a standardized derivative contract created and traded on a futures exchange in which two parties agree that one party, the buyer, will purchase an underlying asset from the other party, the seller, at a later date and at a price agreed on by the two parties when the contract is initiated, in which there is a daily settling of gains and losses and a credit guarantee by the futures exchange through its clearinghouse. Now you can see here, before 2015, there were some learning outcome statements with regards to futures that were a little bit more difficult, and quite frankly, they've been moved into CFA level 2. Okay, so I've had recently, last year and the year before, when people are doing practice questions and they're in a data bank, you can come across old questions, okay? And so the curriculum does change, and that's why I'm bringing this up right now. I had a question from a candidate one time, hey, can you help me calculate the margin, et cetera, et cetera. And I said, you got to look very closely. That practice question, there's no longer a learning outcome statement for that. And so that's one of the issues if you're using question banks or old mock exams. You have to look whether the learning outcome statement is still relevant, okay? So you can see that with regards to this section on futures, in 2005, they made the learning outcome statement a little bit easier. 2014, you had to distinguish between margin in the securities markets and margin in the futures markets and explain the role of initial margin, maintenance margin, variation margin, and settlement in futures trading. And you also had to describe price limits and the process of marking to market and calculate and interpret the margin balance given the previous day's balance and the change in futures prices. So again, for CFA level 1, you might come across some old questions asking you to calculate and interpret the margin balance with regards to a futures contract, but that LOS is gone from 2015 on, okay? So this is my point, is that with regards to the CFA, it's great to do as many practice questions as possible. In the old days, we used to get our hands on as many questions as possible. There wasn't as much choice as there is now. Nevertheless, you always have to be careful that the practice question you're doing is still relevant to the learning outcome statements for the year that you're doing the exam and that they haven't changed, okay? So I just wanted to bring that up in this section to reinforce that point. So continuing with our futures contracts, here's some characteristics. 1, like forward contracts, but they're standardized. 2, they're exchange traded. There is an active secondary market. 3, they require margin deposit. They're marked to market, daily settlement based on the settle price. Margin often referred to as a performance bond or a good faith deposit. Okay, put that little point in there. Deposit required if margin is less than the maintenance margin. There's no default counterparty risk because it's guaranteed by the clearinghouse. And there's limits on daily price moves, a lock limit. So the clearinghouse determines an average of the final futures trades of the day and designates that price as the settlement price. All contracts are then said to be marked to the settlement price. For example, if the long purchases the contract during the day at a futures price of 130 pounds and the settlement at the end of the day is 135 pounds, the long's account would be marked for a gain of 5 pounds. In other words, the long has made a profit of 5 pounds and that amount is credited to his or her account, with the money coming from the account of the short who has lost the 5 pounds. With futures margin accounts, both parties deposit a required minimum sum of money, but the remainder of the price is not borrowed. This required margin is typically less than 10% of the futures price, which is considerably less than in equity market trading. This is referred to as the initial margin. Associated with each initial margin is another figure called the maintenance margin. The maintenance margin is the amount of money that each participant must maintain in the account after the trade is initiated and is always significantly lower than the initial margin. The clearinghouse compares each participant's balance with the maintenance margin. Instead, the short must deposit enough funds to bring the balance up to the initial margin. As with forward contracts, neither party pays any money to the other when the contract is initiated. So that's an important point, put in bold there. Again, with futures, when the contract's initiated, no money changes hands. Value accrues as future prices change, but at the end of each day, the mark-to-market process settles the gains and losses, effectively resetting the value for each party to zero. That's a key important point. So we'll just do a quick practice question. Which of the following derivatives is least likely to have a value of zero at initiation of the contract? A, futures, B, options, or C, forwards? Okay, maybe I put that question in a little bit early because we're going to talk about options more in the future coming up. But which of the following derivatives is least likely to have a value of zero at the initiation of the contract? But we've just been talking about futures and forwards, and we said both have a value of zero. No money changes hands. So a value of zero at the initiation of the contract, futures, that's true. Forwards, that's true. Well, then the correct answer has to be B because it's the false, even though we're going to learn a little bit more about options coming up. But nevertheless, the buyer of the option pays the option premium to the seller of the option at the initiation of the contract. That means there's not a value of zero at the initiation, okay? The option premium represents the value of the option, whereas futures and forwards have a value of zero at the initiation of the contract. A is incorrect because no money changes hands between the parties at the initiation of the futures contract. Thus, the value of the futures contract is zero at initiation. C is also incorrect because no money changes hands between parties at the initiation of a forward contract. Thus, the value of a forward contract is zero at initiation. Good little question. So we're continuing now with futures, and we're going to be talking about the clearinghouse. The clearinghouse moves money between the participants in the futures contracts, crediting gains to the winners and charging losses to the losers. By doing this on a daily basis, the gains and losses are typically quite small, and the margin balances help ensure that the clearinghouse will collect from the party losing money. As an extra precaution in fast-moving markets, the clearinghouse can make margin calls during the day, not just at the end of the day. That's an important point. Some futures contracts contain a provision limiting price changes. These rules, called price limits, establish a band relative to the previous day's settlement price within which all trades must occur. If market participants wish to trade at a price above the upper band, trading stops, which is called limit up, until the two parties agree on a trade at a price lower than the upper limit. Likewise, if market participants wish to trade at a price below the lower band, which is called limit down, no trade can take place until the two parties agree to trade at a price above the lower limit. When the market hits these limits and trading stops, it is called a locked limit. So a quick practice question here. In contrast to over-the-counter options, futures contracts, A, are not exposed to default risk, B, are private, customized transactions, or C, represent a right rather than a commitment. I think that question should be fairly easy. A is correct. Over-the-counter options are exposed to default risk, but futures contracts are standardized transactions that take place on futures exchanges and are not exposed to default risk. That's the role of the counterparty. We saw that, okay? They're not private customized, they're standardized, and they don't represent a right rather than a commitment. They are a commitment. Another quick practice question. Which of the following statements best describes an advantage of a forward contract over a futures contract? A forward contract, A, is essentially free of default risk, B, can be easily offset prior to expiration, or C, allows parties to enter a customized transaction. Again, I think that one should be fairly easy. A forward contract does have default risk. It cannot be offset easily prior to expiration. So C is correct. It allows parties to enter a customized transaction. Unlike futures contracts, which have standardized features, forward contracts can be customized to suit the needs of the parties involved. Moving on to swaps now. The concept of a swap is that two parties swap a series of cash flows. One set of cash flows is variable or floating and will be determined by the movement of an underlying asset or rate. The other set of cash flows can be variable and determined by a different underlying asset or rate, or it can be fixed. Formally, a swap is defined as follows. A swap is an over-the-counter derivative contract in which two parties agree to exchange a series of cash flows whereby one party pays a variable series that will be determined by an underlying asset or rate, and the other party pays either one, a variable series determined by different underlying asset or rate, or two, a fixed series. As with forwards and futures, no money changes hand at the start. Thus, the value of a swap when initiated must be zero. So we're seeing that again. Futures, forwards, and swaps, no money changes hands at the start, therefore the value is zero. Not like an option, where an option has a price and the buyer of an option pays the option premium, okay? As with forward contracts, swaps are subject to default, but because the notional amount of a swap is not typically exchanged, the credit risk of a swap is much less than that of a loan. Quick practice question. An interest rate swap is a derivative contract in which A, two parties agree to exchange a series of cash flows, B, the credit seller provides protection to the credit buyer, or C, the buyer has the right to purchase the underlying from the seller. Okay, this one wasn't tricky at all because it was just asking, it doesn't matter what kind of a swap. A swap is a derivative contract in which two parties agree to exchange a series of cash flows. That's it, that's the definition. So A is correct. An interest rate swap is defined as a derivative in which two parties agree to exchange a series of cash flows. One set of cash flows is variable and the other set can be fixed or variable. B is incorrect because a credit derivative is a derivative contract in which the credit protection seller provides protection to the credit protection buyer, okay? But don't worry about that for now. And C is incorrect because a call option gives the buyer the right to purchase the underlying from the seller. It gives you the right but not the obligation when you're dealing with options. Another quick practice question. Which of the following distinguishes forwards from swaps? A, forwards are OTC, over-the-counter instruments, whereas swaps are exchange traded. B, forwards are regulated as futures, whereas swaps are regulated as securities. C, swaps have multiple payments, whereas forwards have only a single payment. I think that was an easy question. C is correct. Forwards and swaps are over-the-counter instruments and both regulated as such. Neither is regulated as a futures contract or a security. A swap is a series of multiple payments at scheduled dates, whereas a forward has only one payment made at its expiration date. Now we're moving on to contingent claims. A contingent claim is a derivative in which the outcome or payoff is dependent on the outcome or payoff of an underlying asset. Although this characteristic is also associated with forward commitments, a contingent claim has come to be associated with the right, but not an obligation, to make a final payment contingent on the performance of the underlying. Given that the holder of the contingent claim has a choice, the term contingent claim has become synonymous with the term option, okay? So we're talking about contingent claims in general, we're talking about options. The holder has a choice of whether or not to exercise the option. That gives you the right but not the obligation. This choice creates a payoff that transforms the underlying payoff in a more pronounced manner than does a forward, future, or swap. Forwards, futures, and swaps provide linear payoffs. As the underlying goes up or down, the derivative gains or loses. The further up or down the underlying goes, the more the derivative gains or loses. Options are different in that they limit losses in one direction, okay? So when you buy an option, your maximum downside is just the premium that you've paid. In addition, options can pay off as the underlying goes down, for example, buying a put option. Hence, they transform the payoffs of the underlying into something quite different. So now we're looking at options. An option is a derivative contract in which one party, the buyer, pays a sum of money to the other party, the seller or writer, and receives the right to either buy or sell an underlying asset at a fixed price, either on a specific expiration date or at any time prior to the expiration date. Options that can be exercised early are referred to as American style. Options that can be exercised only at expiration are referred to as European style. It is extremely important that you do not associate these terms with where the options are traded. It's just a name, okay? Both types of options trade on all continents. The fixed price at which the underlying asset can be purchased is called the exercise price, also called the strike price, the strike, or the striking price. The buyer pays this writer a sum of money called the option premium, or just the premium. Now in the text in this chapter, there's quite a few pages on the with charts and the payoffs, but nevertheless, in the reading risk management applications of option strategies, we'll cover all the payoffs. So not going to get into the charts at this point with regards to this LOS. We'll get into it later on in another reading, in another learning outcome statement. Okay, just be clear on that. There is a section in this reading that has the option strategies, shows you the chart for the put and the call, but we're going to cover that later on. Okay, because there's another reading, risk management applications of option strategies, where you determine the value at expiration, the profit, maximum loss, break even, etc., and the payoff graph. So rather than doing it twice, we're just going to do it once when we cover that learning outcome statement in that reading. Okay, I just want to remind candidates that this is the reading Derivative Markets and Instruments. It's a bit of an introductory reading. Nevertheless, there is an exhibit that has the payoff and profit from a call option, and if you scroll down, it's got the payoff and profit from a put option. Again, this is just an introduction, but don't worry, because 2 readings later, when we get into the reading risk management applications of option strategies, the learning outcome statement is determine the value at expiration, the profit, maximum loss, break even underlying price at expiration, and the payoff graph of the strategies of buying and selling calls and puts, and determine the potential outcomes for investors using these strategies. So we're not going to get into the charts at this stage. We're going to wait until that reading and that learning outcome statement. Okay, just wanted to point that out. So we're going to push ahead now and look at credit derivatives. A credit derivative is a class of derivative contracts between 2 parties, a credit protection buyer and a credit protection seller, in which the latter provides the protection to the former against a specific credit loss. One of the first credit derivatives was a total return swap, in which the underlying is typically a bond or loan, in contrast to, say, a stock or a stock indexed. Another type of credit derivative is the credit spread option, in which the underlying is the credit yield spread on a bond, which is the difference between the bond's yield and the yield on a benchmark default-free bond. A third type of credit derivative is a credit-linked note. With this derivative, the credit protection buyer holds a bond or loan that is subject to default risk, the underlying reference security, and issues its own security, the credit-linked note, with the condition that if the bond or loan it holds defaults, the principal payoff on the credit-linked note is reduced accordingly. Okay, on the last slide, we looked at the 3 credit derivatives, the total return swap, the credit spread option, and a credit-linked note. But these 3 types of credit derivatives have had limited success compared with the 4th type of credit derivative, the credit default swap. The credit default swap, in particular, has achieved much success by capturing many of the essential features of insurance while avoiding the high degree of consumer regulations that are typically associated with traditional insurance products. So a credit default swap is a derivative contract between 2 parties, a credit protection buyer and a credit protection seller, in which the buyer makes a series of cash payments to the seller and receives a promise of compensation for credit losses resulting from the default of a third party. So you can see the little graphic here. We've got a lender and we've got a borrower, okay? Of course, the borrower is paying back interest and principal payments. So the credit default swap, you can see that the CDS seller is going to make periodic payments and is going to be compensated if there's any credit losses. So a quick practice question here to help consolidate our understanding. Which of the following derivatives is classified as a contingent claim? A, futures contract, B, interest rate swaps, or C, credit default swaps? Aha, this one was a little bit tricky. We know that options are a contingent claim, and now we've learned something new, that C is correct. A credit default swap is a derivative in which the credit protection seller provides protection to the credit protection buyer against the credit risk of a separate party. CDS are classified as a contingent claim. A is incorrect because we know futures contracts are classified as forward commitments, and B is incorrect because interest rate swaps are also classified as forward commitments. So if you remember that futures and swaps are not contingent claims, then you would have kind of figured out that C was correct and credit default swaps are a contingent claim. And one last practice question to finish this learning outcome statement. A credit derivative is a derivative contract in which the A, clearinghouse, provides a credit guarantee to both the buyer and seller. B, seller provides protection to the buyer against the credit risk of a third party. Or C, the buyer and seller provide a performance bond at initiation of the contract. B is correct. A credit derivative is a derivative contract in which the seller provides protection to the buyer against the credit risk of a third party. So it's like insurance, okay? The seller provides protection. That's what happens when you buy insurance. When you buy insurance, the seller is providing you protection. Just think of it that way and get the wording right, okay? That's the last slide for this LOS. Thank you.